Right now, mortgage rates are sitting right around 6%, which is the lowest level we've seen since February of 2023. So when people hear this, the immediate reaction is, okay, this is it. Rates are about to break lower. This is the start of the move. And then the follow-up question is always, should I wait? So before we even touch the Fed, inflation, or the new Fed chair, we need to start with why rates are here in the first place. Because if you misdiagnose that, everything else we're going to talk about is going to fall apart. Rates did not drop because inflation suddenly collapsed. They didn't drop because the economy rolled over. What really moved the needle was President Trump directing Fannie Mae and Freddie Mac to purchase about $200 billion in mortgage-backed securities. Now, understand, that's not a small adjustment. That's direct demand injected into the mortgage-backed security market. And when you increase demand for mortgage-backed securities, yields compress. And when yields compress, mortgage rates improve. That's just how the plumbing works. Now, with that said, here's where most people get tripped up. They see rates fall and assume the trend has shifted structurally. But what happened here was mechanical. We had artificially wide spreads for years after COVID. Lenders were demanding more yield over treasuries because of volatility, prepayment risk, regulatory issues, you name it. That spread blew out over 3% at one point. Historically, it should live closer to 1.6 to 1.8%. When that mortgage-backed security demand came in, spreads compressed back to what's more normal, roughly 1.8 to 1.9%. That compression alone explains most of the move. So the question isn't, are rates falling? The question is, what could cause spreads to compress even further from here or send the 10-year lower? Because if spreads are already back in a normal range, you don't get another 50 basis point move just from normalization. You would need something fundamentally different, like the 10-year moving lower. I just want to take a minute here and say thank you for watching. I appreciate the support. If you find any value today, make sure you hit that thumbs up and please consider subscribing to the channel. Now, this is where the Fed comes in, but we have to talk about the Fed correctly. The Fed does not control mortgage rates directly. They influence financial conditions, yes, but here's the thing. Mortgage rates trade off expectations, things like inflation, growth, risk appetite, global capital flows. And the Fed itself isn't one person, it's a committee. You've got permanent governors, rotating regional presidents, voting members, dissenters. But with that said, the chair is the loudest voice in the room, absolutely. They shape forward guidance. They answer questions, they frame the narrative, but they do not dictate outcomes unilaterally. And right now, the committee isn't perfectly aligned. Some members are looking at inflation and saying, we've made progress, but we aren't convincingly at 2% yet. Cutting too soon risk undoing that progress. Others are looking at employment and saying, policy is already restrictive. The labor market is cooling. If we don't move soon, we risk over tightening. And here's what's important. That split matters because it keeps policy gradual. Now layer on the current expectation. 2 rate cuts this year. First one likely July. Second one around October. The first one was originally expected in June, but stronger than expected data pushed it out. But here's the important part that I think most people miss entirely. The bond market already expects that. Those 2 cuts are already baked into the cake. If you're sitting around thinking, I'll wait for the July cut and rates will be lower, understand that unless something changes between now and then, the impact of that cut is largely priced in already. Markets move on change in expectations, not confirmation of expectations. Now let's talk about the data that could actually change those expectations. Inflation has improved. CPI is currently sitting at 2.4% year over year, which again, meaningful progress. But PCE is still closer to 2.9%. And at the same time, core measures are still sticky, which basically means it's not screaming mission accomplished. Yes, trueflation is showing something closer to 1%. And if that flows into official data over the next couple of months, that's your potential catalyst. But the Fed doesn't move on alternative data sets. They move on confirmed, repeated official readings. Now let's take a minute here and talk about employment. Employment is weakening, yes. Hiring is slower, wage growth is cooling, job openings have come down, but unemployment hasn't spiked. In fact, it's actually gone the other way. On top of that, we're not seeing a broad-based labor collapse, and that distinction is critical. There's a difference between cooling and cracking. Cooling allows the Fed to move slowly. Cracking forces aggressive cuts. And right now, or cooling. So unless employment meaningfully deteriorates, you don't get emergency rate cuts. You get gradual policy shifts. Now, let's talk about the new Fed chair, because I know that's what's driving headlines. There's the belief that because Trump wants lower rates and selected Kevin Warsh, that automatically means rates are going lower. But understand, Warsh has historically criticized keeping policy too loose for too long. He's criticized prolonged balance sheet expansion and continued mortgage-backed security buying during the pandemic. So if anything, if the Fed were to become more aggressive about shrinking the balance sheet or pulling back support from mortgage-backed securities, that could actually cause spreads to widen again. And if spreads widen, mortgage rates rise, even if inflation is stable. So assuming a leadership change equals cheaper money ignores the mechanics of how mortgage rates actually work. When I zoom out and look at everything all together, here's what I see. Spreads have normalized, mortgage-backed security support compress yields, inflation is improving, but it's not fully resolved. Employment is cooling, but not collapsing, and at the same time, 2 rate cuts are priced in. The Fed is cautious, but yet divided, and that leadership change only adds more uncertainty. And in my opinion, that environment does not scream rates are about to fall another 0.5%. To me, it looks like range-bound rates with volatility. So if I'm being completely honest, from 6%, the risk probably skews slightly to the upside unless inflation breaks meaningfully lower or employment cracks. Not dramatically higher, but slightly more risk up than down. So if I'm buying and I'm comfortable with the payment at 6%, I'm locking in most cases, because I don't think you get rewarded for waiting on something the market already expects. If rates improve later, then you refinance, assuming you still have a job, you still have the income, you still have equity in your property, and at the same time, if they move higher, you can't go back in time. Which, when you're looking at the 30,000 foot view, that's risk management. And I think that is where most people get emotionally caught. Because when rates hit a 3-year low, it feels like momentum. It feels like the beginning of something. Human nature wants to extrapolate the recent trend forward. But markets don't move because something feels like momentum. They move because expectations shift. And right now, expectations haven't shifted meaningfully. The market expects 2 cuts. The market expects inflation to continue cooling gradually. The market expects employment to weaken slowly, not collapse. That's the base case. So unless something deviates from that base case, you don't get a big move. Now, if you're watching this and you're thinking about buying a house or refinancing, you're not sure where to start, maybe you got quotes and you're not happy, or you're just trying to get another quote out there, make sure you use that link in the description of the video. You can connect directly with my team and we can guide you through that process. We help hundreds of people here on YouTube, and we'd love the opportunity to help you too. Just check that link below. Now, could inflation break faster than expected? Yes. If CPI and PCE both start printing closer to 2% for multiple months, you'd likely see the bond market move ahead of the Fed. You might even see the 10-year drop further and mortgage rates drift into the mid to high 5s, but that would require confirmation. And on the flip side, if inflation stalls or worse, ticks back up, that's when you see rates move higher quickly, because the Fed would immediately lose flexibility. The same is true with employment. If unemployment starts rising quickly, that changes everything. The Fed would likely accelerate cuts, the bond market would rally hard, and mortgage rates would follow. But that's not where we are. We're in this uncomfortable middle ground. Inflation is better, but not beaten. Employment is softer, but not broken. And the Fed is operating in that middle ground. That's why the split inside the Fed matters more than the headlines. Because some members are laser focused on not repeating the mistake of keeping policy too loose for too long. They believe that cutting too early risks a second wave of inflation. Others are more concerned about tightening into a slowdown. Those two philosophies don't produce dramatic moves, they produce compromise. And compromise looks like 2 measured cuts, not 6. Now bring in the new Fed chair. Even if Kevin Warsh leans slightly more hawkish on balance sheet issues, he still has to build consensus. And even if he personally wanted faster cuts, he'd still have to navigate the committee. And here's the thing, the bond market is watching all of it. If markets sense the Fed is becoming more tolerant of inflation, yields rise. If markets sense the Fed is over-tightening into weakness, yields fall. It's not about personality, it's about credibility. And credibility is earned through data, not rhetoric. Now, with that said, let's go back here and talk about spreads for a second, because this piece is important and a lot of people overlook it. We've already normalized from over 3% down to 1.8%, which is a huge move. For spreads to compress further from here, you likely need either renewed aggressive mortgage-backed security support or a dramatic drop in volatility. Neither of those is a given. In fact, if anything, volatility tends to increase during leadership transitions and policy uncertainty. So when I say that rates are likely range-bound, I don't mean stuck to the exact basis point. I mean oscillating within a band based on data surprises. You could see 5.85, you could see 6.25, you could even see 6.35. But without a clear catalyst, you're not likely to see a straight line drop to 5.5, 5.75 for that matter. And that's the part I think buyers need to hear, because I talk to people every day who are delaying major life decisions, waiting for that one perfect rate. And perfection almost never shows up cleanly. What usually happens is this: rates dip, people hesitate. Rates tick up, people regret. Rates dip again, people hesitate again. And the cycle continues. Meanwhile, life moves on and property values continue to rise. So if you zoom out, the question shouldn't be, are rates going to 5.75% next month? The question should be, does this payment make sense for my life and my timeline? Because from a macro standpoint, the environment we're in right now is not screaming dramatic easing. It's screaming cautious normalization. Now that's completely different. Now I want to be clear about something else. I'm not saying rates can't go lower, because they absolutely can. But the burden of proof right now is on the data to force that move. And until that proof shows up in inflation or employment in a meaningful way, we're likely grinding sideways with volatility. And in a sideways volatile environment, the bigger mistake is usually overconfidence. If someone tells you with certainty that rates are about to collapse, they're guessing. If someone tells you with certainty that rates are about to spike, they're guessing. The honest answer is that the most probable outcome right now is a range somewhere between 6 to probably 6.5%. So when I say there's slightly more risk to the upside from here, I'm not predicting a surge. I'm saying that spreads have already normalized, 2 cuts are priced in, and the economy hasn't broken. That combination doesn't create asymmetrical downside for rates. It creates balance, and balance feels boring, but boring is usually what you get in between major cycles.